We're diving into the world of AutoZone today.
Okay, yeah.
Now, I know what you might be thinking, auto parts.
Right.
Sounds a bit mundane.
It's not the most exciting industry.
But stick with us.
Okay.
Because this company's performance has been anything but boring.
It's a classic example of finding hidden gems in unexpected places.
Oh, yeah.
While everyone's busy chasing the latest tech trends, AutoZone has been quietly generating impressive returns for its investors.
And we're not talking about small gains here.
No.
The article we're looking at throws around a pretty eye-popping number, a 4,000% return over the past 2 decades.
Wow.
That's enough to turn a modest investment into a life-changing sum.
It's truly remarkable, and even more so when you consider that this growth occurred despite AutoZone's sales only tripling during the same period. This tells us they're incredibly efficient at turning those sales into profit.
So it's not just about selling a ton of stuff.
Exactly.
It's about making sure that every sale counts.
Precisely.
Interesting.
It speaks to the efficiency of their operations.
The Motley Fool article digs into 3 key reasons behind AutoZone's success.
Okay.
And the first one really caught my attention. Return on invested capital, or ROIC.
Right.
Now, I'll admit this sounds a bit jargony.
Sure.
But help us understand, what does ROIC actually mean for, someone who doesn't spend all day poring over financial statements?
Imagine this. You decide to open a lemonade stand.
All right.
You invest in lemons, sugar, and maybe a fancy sign.
Got it.
Your ROIC measures how much lemonade in profit you squeeze out of every dollar you spent setting up your stand. A high ROIC means you're running a tight ship, turning a tidy profit on every investment.
So a high ROIC means you're basically a lemonade-selling superstar.
Exactly.
Okay.
And when it comes to AutoZone, they've been averaging a staggering 53% ROIC over the past decade.
Wow.
To put that in perspective, a 10-15% ROIC is considered average for companies in the S&P 500.
Okay.
AutoZone is in a league of its own.
So they're not messing around.
Not at all.
A 53% ROIC means that for every dollar invested, AutoZone generates an additional 53 cents in profit.
That's right.
Think about that. If you were getting that kind of return on your savings account, you'd be ecstatic.
Absolutely. And this exceptional ROIC points to something else. The Motley Fool highlights AutoZone's wide moat.
A moat.
Yeah.
Like, are we building a castle now?
Not quite, but you're on the right track. In the business world, a moat refers to a company's competitive advantage.
Oh.
Think of it like a castle's defenses.
Right.
But instead of protecting against invading armies, it's about protecting against competitors.
Got it.
AutoZone has built a wide moat around its business, making it difficult for rivals to steal their market share.
So what exactly makes up AutoZone's impressive moat?
Well,
What are their defenses?
they've strategically cultivated a few key advantages.
Okay.
First, there's their brand recognition.
Yeah, right.
They've built a reputation for quality and reliability.
That makes sense.
Yeah,
When you need a car part, you want to be confident you're getting something that's going to work.
absolutely.
No one wants to be stranded on the side of the road because they went with a cheaper but potentially unreliable option.
Exactly.
So brand recognition is huge.
Oh, absolutely.
What else contributes to their moat?
Well, in addition to their strong brand, they've also cultivated a vast network of stores.
Yeah.
They're practically everywhere, which makes them incredibly convenient for customers.
You're right. I can't think of too many times I've had to go searching for an AutoZone.
Right.
They always seem to be right around the corner when I need them.
Exactly. And let's not forget about their strong relationships with both DIY customers like yourself and professional mechanics.
Right.
They've positioned themselves as a trusted partner for everyone from the casual car tinkerer to the seasoned professional. But having a strong moat is only part of the story.
Right.
The Motley Fool article's second key point highlights AutoZone's impressive reinvestment runway.
Okay, so it's not enough to just have a great business model.
Yeah.
You also need to know how to use your profits to keep growing. What does that look like for AutoZone?
Think of it this way. Even the most well-maintained car eventually needs new parts.
Right.
AutoZone is looking ahead, anticipating future needs, and making sure they're prepared to meet them and their plan. They believe they can add a staggering 4,000 stores just within the U.S.
Wow, 4,000.
Yeah,
But they already have over 6,400 stores.
they do.
It seems almost impossible to find that much space to grow.
It's ambitious.
Yeah.
But the auto parts industry is ripe for consolidation. There are still countless small, independent auto parts stores out there as the industry giants like AutoZone continue to expand. They're in a prime position to acquire these smaller players or even squeeze them out of the market altogether.
So it's a bit of a David and Goliath situation.
Kind of.
With AutoZone playing the role of Goliath.
Precisely. It's a classic example of industry giants flexing their muscles. But there's another strategy AutoZone uses that the Motley Fool highlights: buybacks.
Ah, yes, the buyback bonanza they mention.
Right.
That's where a company buys back its own stock, right?
That's right.
It always seemed a bit counterintuitive to me.
I understand why it might seem strange at first, but think of it this way. When a company buys back its own shares, they're essentially saying they believe their stock is undervalued. It's like they're putting their money where their mouth is.
So they're betting on themselves, which, given their track record, seems like a pretty safe bet.
Right.
But how does this actually work to benefit long-term investors?
When a company buys back its shares, it reduces the total number of shares available on the open market. This, in turn, increases the ownership percentage of the remaining shareholders, those who believe in the company's long-term vision and are holding on to their stock. The article mentioned an incredible statistic, a 79% reduction in outstanding shares since 2004.
Wow, 79%.
Yeah.
That's a huge vote of confidence in their own business.
It certainly is, and for those long-term investors, this consistent reduction in shares has amplified their earnings per share, making each share more valuable. Think about like concentrating a delicious sauce. Same ingredients, but a richer, more intense flavor.
I like that analogy.
Good.
Okay, so we've talked about AutoZone's impressive ROIC, their wide moat, their reinvestment strategy, and their commitment to buybacks. But there's one more thing we need to address: the elephant-sized electric car in the room. What happens to AutoZone's business when everyone is driving EVs? I mean, aren't electric cars supposed to be more reliable, needing fewer repairs?
That's the million-dollar question, isn't it?
Yeah.
And it's a valid concern.
Because even with the best moat in the world, if the whole market shifts beneath you, you're still in trouble, right?
Exactly. But AutoZone is already making moves to adapt.
So they're not just letting the EVs, like, run them over?
Right. Yeah.
They're already thinking about this?
They are. They're not just sitting around.
Yeah.
The article mentions they're building these specialized hubs with significantly more inventory capacity.
Interesting. So it's like they're building a bigger barn?
Right.
But we don't know what we're going to put in it yet.
Exactly. That's the intriguing part. It suggests they're preparing to stock a wider range of parts, possibly, including those needed for EVs.
Yeah, so instead of just brake pads and oil filters, they might start stocking charging cables and whatever else goes into these electric engines.
The whole new ballgame.
It is. What do you think, listener? Does this signal a company that's future-proofing itself or making a risky bet on a fading technology? It's certainly a development worth keeping an eye on, but pivoting to a completely different kind of car part can't be easy.
No, it's a significant challenge. One of the key questions is profitability.
Yeah.
Do EV parts offer the same profit margins as traditional parts? We'll have to wait and see how AutoZone navigates this transition.
Yeah, because like they've been running this marathon for decades.
Right.
And now right at the finish line, there's this hurdle they've never seen before.
Exactly. And to make things even more interesting, they're facing this hurdle at a time when their valuation seems surprisingly reasonable.
Because their price-to-earnings ratio is still pretty good, right?
It is. Even after its stellar performance, AutoZone's PE ratio is actually lower than the average for the S&P 500.
So it's like finding a vintage car in mint condition.
Right.
But they're selling it at a discount.
Precisely.
Mm.
It's an interesting situation that makes AutoZone potentially appealing, both for new investors looking to buy in and for the company itself to continue its buyback spree.
Interesting. So where does this leave our listeners? Should they be rushing out to buy AutoZone stock right now?
Well, we always encourage you to do your own research.
Of course.
And make investment decisions that align with your individual goals and risk tolerance.
Because as much as we love talking about this stuff, we're not financial advisors.
Exactly. But I think AutoZone's story offers a powerful lesson. It reminds us that boring doesn't necessarily mean bad investment. Sometimes the companies quietly keeping the world running, like those providing essential car parts, offer the most stable and rewarding returns.
It's all about looking beyond the flashy headlines, asking the right questions, and, doing a little bit of digging. And that's what we try to do here on the Deep Dive.
Absolutely. And in the case of AutoZone, the biggest question might be, do you believe in the long-term future of cars? If so, AutoZone, with its strategic positioning and track record, might just be a company worth considering for your portfolio. But that, as always, is for you to decide.
AutoZone, a fascinating company. Thanks for diving in with us today.